Today we're discussing Blackrock Enhanced Dividend Trust. It's a 4-star fund on Morningstar, and it yields almost 10%. Here's Blackrock. We have about 15,000 in it, and we're down in it still in the position, and so it might be a time to add 5,000 or so more to the position, but right now we are so dominant in these other funds like Cornerstone that which represented most of our gains today. Of the 13,000 we're up today or so, 11 of it was Cornerstone, and that's also a 4-star fund, and we have about 400 grand in that fund. But Blackrock is a 4-star fund. We have 15 in it. Let's go check it out on a chart, because this is the main reason I'm making the video about it. The chart looks like it's near a bottom. So if you look at just simple highs and lows and you look at the range that it's in, it's definitely at the low on its chart. Plus, the dividend shows here almost 10%. Now, I did the math of my own, 0.056. So 0.056. If we go into the calculator and we do $10,000 divided by 8.55, because that's the share price, right? 8.55, roughly, yes. And then what's the dividend? 0.0562. And so if we multiply this times 0.0562, we get $65 times 12. So $800, so it's about 8%, 788. It's about 8% on 10,000 invested. BDJ is a 4-star fund, and it has a $10,000 scenario that it shows for every fund, and here it shows that 10,000 made 40,000 over the last 10 years, and that's in line with the S&P. So that's really good, except this pays you a dividend, so you get to qualify to banks with it. If you just bought SPY, the bank doesn't take capital gains for loans. It takes dividends or pay stubs from a job. So the dividends from Blackrock allow you to qualify for more loans. Also, it shows you the NAV here. The NAV, that's at a premium. It's at a discount to NAV, a negative 0.12 discount to NAV. So that means it's traditionally a good time to buy. Anytime a fund is near its NAV, it's a good time to buy. And speaking of that, I just want to show you Cornerstone. It's only 15% above its NAV right now, and usually it trades at a 25 to 30% premium to NAV. So look out for Cornerstone. Go see my past videos on Cornerstone if you haven't already. So anyway, Blackrock. Also, I just want to show you their website. Here it shows you not only their holdings, but I wanted to show you their sector allocation as well. So their holdings, they have some of the top 10 companies they have here. Wells Fargo, Citigroup. These are financials. You also have Enterprise, which is a pipeline company, and Medtronic, healthcare equipment. Obviously, General Motors, the car company. Consumer, cyclical. So these are the top 10. Cisco, that's tech. AIG is financial. JP Morgan, tech, financial. So they look heavily comprised of financials and healthcare. 20% is in healthcare, so that's about in line with what we saw. 20% healthcare and about 20% financials. And then it drops to 10 and 10 and 10, and then 5s for everything else. So it's pretty dominant into healthcare and financials. So I would say that this fund held up pretty well recently, considering all the financial melee in the sector. So Blackrock, if you want to play financials, that's a good way to also play it, because it has 20% exposure to financials. So one more time, I just want to show you a chart, show you the max time frame. See, it's at the lows. $8 seems to be, it's the 2018 low, it's 2016 highs, 2008 highs, basically 2010 highs. So we're in this range where it's a pretty good opportunity to buy, and it doesn't seem like there's anything wrong with the banks. And if you go on a macro point of view and you look at interest rates seem to be falling now. as inflation is falling and companies' earnings are hanging in there and staying strong, and the consumer still has jobs. 3 to 4% employment is what we're seeing. So everything is just looking like an all systems go for the economy, and I've been making past videos on this, pounding the table on the bullishness of the macro picture in the economy with lower rates, lower inflation, high jobs, high earnings for the S&P, and low prices in all of the sectors. So if you look at just a quick top-down, approach, looking at the 10 sectors of the S&P, we know that healthcare is cheap, so I just go to Cure. That's a healthcare ETF. It was at 120, now it's at 90, so a nice pullback there for healthcare. We could go to all the sectors if you want. Energy, just look at EOG. It's the bellwether for energy drillers. EOG resources in the S&P 500 has pulled back. 1 year chart, you can see how much it's pulled back from 150 to 100. I mean, it makes me want to take a stab at EOG myself, but I'm in Devon, DBN, which is also in the S&P, and it's a world-class company. So that's our exposure to energy. It's our representation to energy is Devon. We made past videos on that. It was at 70, now it's at 50. So you have almost 50% upside in energy, it looks like. EOG was had the same type of chart. We just showed you healthcare, technology. We all know that technology is cheap. I mean, technology got hurt the most in 2022. So QQQ is way off its highs, even though it's breaking out, and we made a video on that recently. It was at 400, so now it's at 300. You have about 25% upside there in technology. We could go to consumer cyclicals, XLY is the best way to look at consumer cyclicals. It's pulled back significantly from 200 to 145. So you have almost another 20% up to 25% upside in that. You have non-cyclical, which that was strong in 2022. So those companies are probably starting to pull back now, if I remember correctly, because they're starting to, inflation's falling, so they're going to lose their pricing power. Yeah, General Mills had its pullback, but now it's on the way back up, and that's probably because recently we had the scare with SVB fallout, and people wanted to go more defensive, so they went back into staples, consumer non-cyclical. Mo is cheap. I know that. That's our consumer non-cyclical play. It's unethical with tobacco, but it has a high dividend. That's why we're in at 8%, 8.5%. So this is kind of a mixed bag. We could go to Kellogg's. Just check that out real fast. Kellogg's, yeah, it's looking pretty cheap actually. 3.5% dividend. Wow, look at that on the chart. Was at 75, now it's at 65. Looks like the time to buy Kellogg, in my opinion. It was pulling back recently because inflation, I guess, was pulling back and people were getting ahead of that trade. This chart's not working. I've tried showing you this chart before. It's not working. Okay, there we go. So 1 year chart on Kellogg's. Yeah, and Kellogg is a best of breed. It's in the S&P 500. This is where you would buy under the 200-day moving average there, the orange line. Again, on a 1 year chart, we're below that 200, but the downtrend can't last forever. On a max chart, we're almost there at 60, so 66. So I would buy half a position now and half at 60. It was again at almost at 80. And over time, this thing makes higher highs and higher lows. As you can see, it just rides this chart, this 200-day moving average. We're almost there. So I'm gonna take a stab at this right now and buy, just to keep my eye on it. I'm gonna buy 500. I need some more consumer, non-cyclical anyway exposure. I have Mo, but that's not enough. So we'll do a small amount, because as you know, all of my money is in the indexes. So just to keep our eye on that, and it has a dividend, so it covers most of my margin interest. which is around 5%. So going to the portfolio, I just want to show you really quick my margin debt, which is around 300K. It's just under it at 296.8. So that'll be tomorrow 297.5 as Kellogg gets entered in. So our estimated income was about 100,000. So it'll bump up our estimated income, but not by much. So we're at about 102 for estimated income for the year, all dividends and distributions we receive from these holdings. I could run through the other sectors if you like. I bought BHP today. BHP, that's metals and mining. I'll just show it to you down here. BHP, metals and mining. So this stock had its pullback, recently. So I'm buying that, and it just got above its 200-day moving average today. I want to also show you the S&P. The S&P just got above its 200-day moving average. It's very important. Okay, this chart doesn't do any justice. We need to go in here, and it needs to show us the 200-day moving average. There we go. So see how we just got above this orange line? That's very significant. In the past videos, I was talking about how it's, it could break the 200, which it did right here, and it could hug it, and it could stay tight as the moving averages stay tight, and moving averages have stayed very close together, as you can see there, and it's been a tight range. And I said that we could fall back to 380 because that was the last support, and here we are at 380. We bounced off of that, and today we made it above the 200, which is, again, very significant. And we were just at 420, as you can see, 420, and so that's the next resistance. We'll see if we hold there. We'll probably hit that or go somewhere close to it, and then pull back again to 400 as we chop around and people, make more headlines, fear-mongering headlines about how the recession's coming and inflation may not be out of the woods. We may not be out of the woods inflation yet. Inflation is still rising or something like that. We might have to raise rates. But that would just mean that we're in a strong economy, and to just keep buying every dip, as I've been saying. This market is 20% off the highs. It can't stay down forever. It averages 7% per year over time. So we've just been consolidating. This was the bottom here at 350, which was the old Corona high, pre-Corona high, which I've just made tons of videos about. Go see our past videos if you like. And the NASDAQ is breaking out as well. I think I just showed you that briefly. And as we ran through some of the sectors, we did four of the top 10 sectors. BHP, I just showed you that. And we know the financials are cheap. They just pull back. I don't think I need to show you the financials. Go check out my past videos on that. I showed you consumer cyclical with XLY. I showed you non-cyclical. I showed you healthcare, utilities. Okay, well, we can do utilities and industrials. So here's the industrials. It's, it had its little pullback. The Dow's pulled back for the year. This looks like a decent entry point. I think it's had a big run and it's elevated compared to other sectors, but it still has a decent entry point. So everything is looking like it's either really cheap and going higher, or it's within an uptrend and pulled back, like utility, like industrials, and it can move higher. Utilities here had a nice pullback, and I definitely want to add to some utilities here. Could even just buy this sector itself, XLU, 3% dividend, but I'd like to go for the stocks. The stocks have bigger dividends. So I take all these stocks and I make them about 1,000, and I keep them fully diversified. The stock side of the portfolio, I keep one in each, and I keep each sector in there. So BXP, Mo, there's our consumer non-cyclical. Goggle's actually an industrial. It's shipping. It's considered an industrial. And look at Goggle. It's cheap. Has a 20% dividend. And shipping is really volatile, but it's had its pullback. We made a lot of money on this last year when the dividend was much higher, but now it's had its pullback. So I put a small amount on that. It fits industrial. See, it's industrial. So it just fulfills industrial exposure for my portfolio. I'm not saying it's a good pick for everyone, and it has a big enough yield to cover the investment. Even if it loses, that yield should pay back the investment. even though they keep cutting that yield, I'm up big on that stock over time, so I just have a small amount in it now. So anyway, I just kind of wanted to give you this rundown on everything else. Everything else that I've been talking about though is in BDJ. So not Goggle, that's not in the S&P, but BDJ holds top S&P 500 companies, and every sector that we just ran through, it has some of it in its fund, and so you don't have to be buying all these. You could just buy BDJ. So that'll do it for this video. Performance and value. I just want to show you before we go that our performance and value has improved. Now we're up 9% for the year versus the S&P is up 5 and Nasdaq's up 11. This number will update tomorrow because we're up significantly today. Again, this we're up 2% today, so that should be closer to 11% tomorrow morning as it updates at midnight tonight. And that'll be how we start reflecting how we're catching up our performance and getting back to our old highs, which was here. We're up about 29% for the year at one point. We fell back with the market as SVB had its fallout issue, and we adjusted everything in the portfolio. We took our lower quality names and replaced them for higher quality names, and reduced all the other lower quality names to 5,000. And we kept those because they have rather high dividends. Kept our higher quality names at 10s and 20s, including BDJ, which maybe I'll add some more to tomorrow, but I'm waiting for a pullback. The market's had a nice run over the last few days, as you saw on the chart. So I'm going to keep BDJ as a result of ending this video, by the way. I'm just going to say that probably not going to buy any more BDJ. It has an 8% dividend. I can find better dividends elsewhere. Cornerstone, even JEPI, I think, has a higher dividend right now. So does USA and some of these other market-related index funds. Anyway, BDJ, 4-star fund, 8% dividend. It's at the lows. I showed you a bunch of things at their lows. You could buy all these individual stocks and sectors, or you could just buy one fund, BDJ. So hope you enjoyed the video. Leave comments if you have any other ideas. Thank you very much.